I would think if you're a casual observer of the student loan debate in the US, you would feel sometimes that it begins and ends with interest rates. Loan refinancing, setting rates at the level of the Federal Reserve, rates for banks, preventing rates from doubling. Yet we heard from Nick Barr, from Lorraine, from others, we heard a lot about interest rate subsidies and the perverse effects of those. Is this a lesson that US policymakers need to absorb, in your opinion?
I think there is too much focus in the U.S. discussion around loans about too much focus on the interest rates. So we've gotten a bit ahead of where we were. We used to, every few years, Congress would debate what the interest rate was going to be. And that would be sort of the extent of the discussion about how we structure student loans. We at least now have an automatic interest rate system where it's based on treasuries plus a spread. But still, you listen to the debate in Congress, the discussions on the campaign trail. Student loans are discussed insofar as it's like interest rates higher or lower. And I think everything we've heard here today is that, yes, interest rates matter a lot to the cost of the program to the government. When it comes to the experience of the students and the borrowers, it doesn't make much of a difference. Right? So what matters for the students and borrowers is what's the structure of repayment? Are they insured against negative shocks? Does the program function administratively in a smooth way? So I would love to see a focus on the students, the borrowers, and their experiences, and I hope that's the lesson that gets drawn.
And by the way, I'll ask these questions of somebody, but if you guys have opinions, jump in. This would be pretty free-flowing.
Well, I would just say that interest rates really do matter to the students in terms of the total cost that they will pay if they receive no forgiveness. But we have to think about both the total cost of financing education while also balancing against the disastrous effect of student loan default. I mean, there was over 1 million defaults last year just on federal direct loans. And that is essentially getting sentenced to a negative credit reporting hit that will make it much tougher to do a lot of other things, not just buy a home and get a car, but also even to pass employment verification checks. So I think there's really two pieces, and as we heard from everybody, the levers are really about how do we figure out how to avoid default and reduce repayment burden. And I think actually we've made pretty great strides here in the US on at least creating options. I don't think we want many more people to use those. But you're right, I think we have to balance it. It's not just interest rates, but structure of repayment plans really, really matters.
Matt, I wanted to ask you, I've always been struck, having sort of looked at this issue for a while, so the US debate is clearly free college and free community college has gotten a lot more attention. Yet when we look at some of these countries, they've very clearly gone in a different direction. They sort of started the system that some proponents want to go to now and used an income contingent loan system to sort of move away from that and increase fees. What's your perspective on sort of the direction of the US debate with respect to free college and the role of income contingent loans?
I think what the discussion today has showed us, in a lot of ways, these are separable issues. We've seen examples of countries, just in the presentations this afternoon, that have free college tuition, but allow students to borrow to cover living costs and have income contingent loans. We've seen the example of the UK, which has increased in recent years what students pay for tuition and has income contingent loans. So I think in a lot of ways we kind of need to separate these issues, and regardless of what you think about what the balance should be between students and taxpayers in terms of paying for higher education, if you're going to have a lending component, an income contingent loan program could very well be part of that. I mean, one of the starkest observations to me today is that we've heard from folks from various countries, from a diverse group of countries, who all seem to be pretty happy with key components of their student loan system, or at least the repayment part of their student loan system. And I don't think really anyone in the US would say that about our system. So I think it stands to reason that we ought to take this seriously. And I think another lesson is, in terms of thinking about, is this feasible? Could this work? Well, clearly it's worked in other places, but that the parameters really, really matter. Right, we heard the example of Sweden, which had an income contingent loan program, ended up abandoning it. probably because it just wasn't designed very well, hadn't gotten the parameters right. And at the same time, I think it's really interesting to think about the ways in which the US is different. And the one that really stood out to me is that we just have this much diverse system of higher education in terms of having kids spread across public institutions, private institutions, for-profit institutions. It seems that there's less regulation of price here than there would be in a country where pretty much everyone's in a public university, where, sure, maybe the institutions can set prices, but because of the kind of governance of the system, it's just much harder to do that. And then, of course, we have 2-year schools, 4-year schools, graduate schools, and I think sometimes that gets lost in some of these comparisons. So what I've taken away from this is that income contingent loans are something we ought to be looking at seriously in this country and figuring out, how could they work here, how could they work well, how could we get it right?
Rohit, picking up on Matt's point, is we obviously have a very different system of higher education in the delivery system than some of these other countries. We have a much more robust for-profit sector. We have a lively debate over that. Does that, in your opinion, make income contingent infeasible, or are there things that you think, do the lessons need to be translated in some way to work in this country?
Yeah, well, I think there's an increasing push to address some of the core of the defaults, which is often concentrated in some poor performing schools. And there are a lot of tools, regulatory tools to do that, everything from dealing with accreditors to state authorizers to how the Department of Ed approves those schools. And I think you're going to see a ratcheting up of using those tools, and I think we've already seen some steps. But, I was really struck, we have differences in our post-secondary system, but I think the differences in our labor market is really what is a big piece of this. So, from 2010 to 2014, unemployment in the US materially went down. The recovery from the crisis actually did, we did see unemployment continually tick down. But the number of W-2s that were issued in 2014 was less than the number of W-2s issued in 2010. And the number of 1099s has surged. And so people use this term gig economy, which I find a little pejorative sometimes. But there is something about our labor market, particularly of younger workers and older workers, that is more in this non-ordinary 9-to-5 or W-2 type system. And so to me, this is a big question on administrability of how we would set up an income contingent system that works with our typical payroll systems. Because if we continue to see the number of workers in our economy outside of the normal employer-employee, every 2 weeks get a paycheck, that is going to be something that I think actually, I don't know these data from continental Europe and the UK, but my understanding is that it's much different here. And I think that's a trend that's going to be really a big challenge in figuring out the nuts and bolts of making that work.
It's much different in that Americans are earning income from other sources or other types.
Correct, and they're not just having one single employer.
This is a challenge for our tax system writ large. This would not just be a challenge this is a challenge for Social Security, right? So the folks who are getting these 1099s instead of W-2s, at some point they have to reconcile their earnings and their taxes and pay their Social Security, potentially pay their self-employment tax, pay income tax. So to the extent that, so Bruce made the point that the marginal cost of an income contingent loan system is very low if you are piggybacking off of your existing structures. Mm-hmm. So if our tax system is going to have to adjust to this new economy, and it better, or we're not going to be collecting the taxes we need to keep the higher education system running, then our collection of student loans should be piggybacking on that structure as well. So I think to the extent that we think of student loan collection as a separate structure that we are building up from scratch, this is expensive and it's burdensome for that matter for the borrowers because you're making them face another set of administrative structures. To the extent that we can organize it with Social Security or organize it with the tax system, that will keep the administrative costs down both for the individuals, the borrowers themselves, and also for the government.
So, I think that today we heard a lot about the sort of differences in repayment terms. How long you pay, what share of your income, what's the threshold, what's the interest rate, when does forgiveness occur. But I actually think, for U.S. policymakers, the much more interesting question is around what we just started talking about now, which is how do you collect payments? Because we already have income-based repayment in the U.S. In fact, 1 in 3 loan dollars right now are being repaid through income-based repayment. So we have it a lot, and it's growing.
I don't think we should be able to use the name. I think it's like a copyright violation that we would use the same name for what we've got that Australia or the UK
Right,
are using.
and so
based on last year's income, but not based in any way on current shocks to my income, the payment is set, and every year I have to go through the process of reapplying for it.
Right, so it's a
I don't think
difference
we have to call it something else.
So it's right, and so the
Banana.
difference is
Call it banana.
we'll call it banana.
Okay.
And the problem with banana is that banana is the formula of income-based repayment, share of your income for a certain amount of time, but you repay it just like you would repay one of your other student loans. Right? And so what's different in these other systems is that it's collected through payroll. Now, that's so you can sort of say, well, why don't we just do that? But we've looked at this pretty hard, and there are some serious hurdles. Now, Sue was sort of glib in saying, oh, it's just like filing your taxes, which of course is super easy, and everybody loves it, right? I mean, and you need, look, I don't need software.
Marginal cost.
I don't need software to pay my student loan.
You're
but you
not
need
the
software.
person I worry about.
Right? No,
Jason.
but I need software to file my taxes. Right? And so this is an issue, right? So we actually have a movement sort of in the policy world, which is why does the IRS make me fill out this long form? Right? Why don't they just tell me what I owe? Okay, so now we have a student loan system that tells you what you owe, and we want to make it more like the tax system. You see what I'm saying?
No, it doesn't have to tell you what you
Right.
owe. You just pay. It's just are you told what you owe for Social Security each month for your paycheck?
No, and
It's
so
just
and
okay.
right,
no.
and so the
it would
combination,
be the
right?
same
So
idea.
well, the
You don't
comparison,
need to know it.
It isn't
doesn't
different
have to.
though,
It doesn't
because
have to bother your brain.
but Social Security doesn't need to know.
Services can't tell you what you owe in an income contingent repayment system now. I mean,
That's
I
right.
understand you
That's
get
right.
some certainty now of what you owe if you don't want to default. I think the policy challenge is we shouldn't have anyone defaulting because they can't afford it. And I think that's the really tricky
You
behavioral
shouldn't have
and
anyone defaulting if
administrative
they
power.
can't afford it either. Right? So, I mean, because we've got some people with very small loans
Right.
who are defaulting. I guess my point is we shouldn't have anyone defaulting. Right?
We won't disagree on that.
So if I might just add, though, the sort of comparison with Social Security is a little bit tricky because, first of all, Social Security, you aren't charged Social Security taxes on income that isn't earned through wages. Right? So if you have someone who earns a lot of income through investments, right, do we want their student loan payment to be calculated off that? Probably. Right? So now the Social Security comparison sort of falls apart.
I wonder
The other
if
thing
people
is
earn
that
money from investments in Australia. It must be impossible.
no, I'm not saying it's impossible, but also not perfectly easy and simple, right? And that's the point I'm trying to make. The other factor here, right, is my Social Security doesn't care what my spouse makes, right? But in income-based payment for student loans, do we care what my spouse makes? Probably.
No, not necessarily.
Or maybe
that.
not,
Maybe
right?
not.
But that's a tricky thing then.
We do in the
because,
current law.
Well, hold on.
We
But
do
that's a
currently.
very tricky thing to deal with because the 1040, the income tax return that you're trying to use, cares very much so what my wife makes. And in fact, the whole thing is designed around what both of us make. So just sort of layering student loans on a system that's designed to collect payments based on household income is very complicated and very difficult. And so these are sort of hurdles that we need to get through. And there are transaction costs. There will be complexity for borrowers. They're probably worth it. I think they're probably worth it. But it isn't just to like flip a switch and suddenly nobody knows they're paying their student loan and never has to fill out any forms.
And just to add my own thoughts, Jason, but having had lots of conversations with you about this, it's been my experience that we have certain design decisions that have been built into our system for a long time. One of them is income-driven repayment is based off household income, and the countries that have done this typically don't have joint income tax
That's key.
filing procedures.
It's a really important
And
point.
so there's certain things that it comes down to a basic trade-off of, if we really want to do this cleanly, then we probably have to do it on individual income, not household income, and we have to accept that we might lose a small amount of money in the process through people who end up not working and live in a household with a working spouse. But these are the kinds of things, that's what it came down to me. If we wanted a system that was something closer to what Bruce described, then we had to sort of go through the system and figure out what all those trade-offs and bite the bullet on some of them.
This reminds me of simplifying the FAFSA, actually. So, are we willing to accept some rough justice in a few cases in order to eliminate 80% of the questions? So, are we willing to see some number of people who, their parents are making, their spouses are making good money, but they're staying home with the kids? Do we let them not pay their loans? Well, if we were not going to allow that, we'd have to move to a household structure. We couldn't do the withholding. So these are decisions we're making about whether we're going to simplify it so it's to the benefit of 90% of people, or are we going to make it extremely complex so we catch the last
Sure.
X percent of
But
people.
I would point out it's not just making sure you capture your spouse's income, right? So if you decide, hey, let's ignore spousal income, that's fine, that's probably the fair way to do it, right? But that makes it more complicated. It doesn't make it simpler. It makes it more complicated because you've got a tax system, a US income tax system, that's designed around a joint income. So now separating
Social
them
Security is
out,
not.
but you wouldn't repay this loan through Social Security.
We could.
You could repay, then, okay.
We've got imaginations here.
You repay it through Social Security, okay.
Sure. I mean, the same process. So this was a suggestion that had been made for the UK by Nick, was that, just as Social Security is your young self, your middle-aged self, paying for your older self, loans are your younger self borrowing against your middle-aged stuff. And you could use the pension program to do the collections. So the Social Security Administration, through its withholding structure that it currently has in place, could be the way that you do this. And it's based completely on, but you would need what do you do about the people who are self-employed? Well, we've got a set of decisions we've made about that.
Right.
I'm not saying, there are no question. Do I think that this transition would keep a lot of think tankers in DC employed for a while trying to figure it out? Yes. Do I think that we are, I hope, as capable of doing that as other countries are? I hope. And the key is that we make it transparent and simple for the borrowers. That we have to be all freaked out by all the spreadsheets and the administrative stuff we need to deal with, fine. But get to the goal where it's simple for the borrowers.
So I imagine we could talk about that for another 25 hours. So let's do it.
Let's do it.
I'm sure during the reception, Jason and then Sue can talk your ear off about that if you'd like. I wanted to ask you, Matt, one of the things that strikes me about when you look out at some of the different countries we hear about is the diversity of designs. And so if you just sort of look at the US context, all of our income contingent loans have had sort of the standard design of an interest rate and a forgiveness period. But when you look at the Australian system, for example, they have a low interest rate but no forgiveness, whereas the UK system looks a little bit more like ours. And of course, the Jeb Bush plan sort of inherited some aspects of the Australian plan. Do you feel like US policymakers could broaden their conception of the different ways that these plans could be designed based on what's been done internationally?
Yeah, absolutely. I think there's lessons to be learned from looking at what other countries have done, how that's worked out, particularly in terms of anticipating unintended consequences that you only learn about, after they happen. One thing you mentioned the Jeb Bush plan, and one thing that I liked about that plan that I don't see in what other countries have done, is linking the percentage of income you repay to how much you borrow. And I think it would go some way towards addressing the concern about concern raised about existing income contingent loan proposals about students being insensitive to price. Now, once again, in a highly regulated, centralized, government-run system like in some of these other countries we've heard from today, I don't think it's as much of an issue. But if we're going to keep our governance structure in the U.S., where you have private nonprofits, for-profits participating, where you have public universities with all sorts of different governance structures participating and have varying degrees of control over their tuition, and you have a a market that's dysfunctional in a lot of ways in terms of not institutions not competing so much on price and quality, or maybe competing on price, but in ways that drive prices up rather than down. I think that that's something we would want to think about more carefully here, and that's why that component of the Jeb Bush proposal was interesting to me. I think the broader issue here in terms of getting, I think one of the challenges here to add to I think I'm in the same camp as Sue and Jason in terms of we can get there, but there's a lot of challenges we have to figure out. So to that list, I guess I would add, how do you get this right? I mean, you're making a commitment. You're offering people contracts that are going to be executed over a very long period of time. And you don't want to end up in the next world of old IBR, new IBR, ICL, ISR, repay. We have re-repay. I'm sure some will have re-repay. So we don't want to end up in that world. At the same time, we want to be able to learn from our mistakes and not have to choose the one true income contingent loan system and be stuck with it forever. So I think it's worth thinking about up front. Is there some way to build some flexibility into these programs where you're sort of necessarily entering into long-term contracts that you really can't mess with once you've entered into them?
Yeah, I think that is similar to the point that Lorraine made around can we future-proof these to some degree. So, I mean, our system, to me, seems the opposite of future-proof. It seems like we tinker every 6 months, and now we got something that is closely approximates a nightmare. So, yeah, trying to build in those flexibilities seems to make a lot of sense.
A lot of the sort of the analytic issues around, so Social Security is decades old now. And over the years, the rate that it has had to charge and the payouts that it makes have varied over time. And the way they've made it work is, they've got a set of actuaries and they've got an administrative board and they've got a structure by which they analyze how long are people living, how much are people making, what kind of tax rate can we have. Note that these all sound kind of similar actually to what you need to do with an income contingent loan system. How long are people living? How much are they making? How much do we need to have them pay in order to pay off what they borrowed? So a lot of the conceptual issues are very much the same. We have not overhauled Social Security every 5 years as the wage structure has changed. We've built in a system such that it is reactive to and flexes with the wage structure and the labor market. We have to do some discrete changes every now and then, but there should be a similar structure, I would think. And any well-functioning loan system here would need to have some sort of intellectual infrastructure, for example, that the Social Security Administration has. A set of analysts who have the wage data, who have the earnings data, the tax data, who have the analytic capacity to get through these calculations. Social Security Administration, I think, is where this, and IRS are where this kind of expertise lies right now. I'm a little less confident that it maybe lies in the Department of Education, but it could be hired. So we got to think about the right place to put something like this.
But doesn't Social Security have more flexibility to change things along the way? I don't know anything about Social Security, but
where'd they get the flexibility?
But in terms of my understanding is Social Security hasn't promised me any specific benefit formula that a bunch of years from now I can sue them to get if I don't get it. Whereas my understanding of student loans is the day I take out the loan, it sets up some set of expectations around repayment, and the government can create repay, but they can't ever take things away. And maybe I'm slightly misunderstanding student loans.
I think the Social Security stuff varies by cohort essentially, right? So a given cohort has a set of expectations in place. But this is getting super nerdy here. But about what their tax rate is going to be and what their payout is going to be, and the next cohort might have a different one based on what's going on. Basically, each cohort has a deal of some sort, but I don't think anybody can sue the government either about what happens with their Stafford loans. I'm not suggesting that, something like you could set it up such that your interest rate or your repayment rate is going to be based on, you'll pay this much if you're below median salary as measured by, the current population, you know what I mean? So it's a set of terms that are understood to the borrower, but also are reflective of what the market is.
I guess what I'm getting at is maybe there'd be desirability in building into the student loan system at the expense of some certainty, some amount of flexibility, since these are long-term things, which is my sense is what we have with Social Security, that if they decide to cut my benefits in half relative to current expectations, they can do that Whereas I don't think we can kick people out of repay or
I think
decide, you
there's
know
some
what,
political
10%, 20 years.
constraints on cutting Social Security payments in half. I think there's some political constraints on that. And similarly, there would be political constraints on vastly changing the terms given borrowers.
It is
So-
a rapidly changing political environment, though, Sue.
well,
There's
as,
stuff going on now that I didn't think was possible a year ago.
as long as enough of us are armed, we'll be able to defend our Social Security payments against them being cut in half.
Jason, you've written a lot about forbearance, and forbearance is kind of a way to offer insurance in our current system, in addition to the other tools. Are some of these things that we have good, protective of borrowers, or I mean, should we maintain them in an ICL system? Or, I mean, what are your thoughts in general?
Yeah, so in the current system right now in the U.S., we have income-based repayment and we have forbearance. And forbearance is, allows you to have a zero payment, basically no questions asked for up to 3 years.
And no documentation.
And no documentation, right? And so, one of the reasons why people use forbearance over income-based repayment is income-based repayment requires phone calls, documentation, sending forms in, and forbearance doesn't.
And then you pay interest.
And then you also, the interest accrues, and it eventually would be added. And so we actually, now if we were to say, but you know what, we have income-based repayment, we don't need forbearance. But I would imagine that sort of the advocacy community would come after me very quickly if I was arguing for that. Because they'd say, well, no, people need forbearance because they need a way to, turn off their loan payments like very quickly and easily. I'm like, well, we have income-based repayment. And they're like, no, that doesn't work quick and easily. Which is sort of my point around, as hard as I think this would be to go to this payroll withholding system, it is the only way to make payments automatically track income, right? And so, like right now, we have this forbearance, which is sort of a clunky way around allowing people to turn off their payments, sort of no questions asked. Like, well, I trust you, you don't need to make a payment, okay, zero. You don't have to fill out a form. But in a payroll withholding system, as you heard a lot of the presenters say today, that you don't have a paycheck, you're not making payments. And the only way you get there is through a payroll withholding. So that's the sort of promise of that kind of system married with income-based repayment. It's just that we just can't, I don't think we should sort of wave our hands at that this is actually does add some complexity. It's not a sort of, it's easier and less complex and makes the insurance aspect of this automatic.
It does. We know that millions of people go into default without ever going into forbearance, right? So even though there's this easy way, people aren't doing it, which is de facto evidence to me that the system isn't working as it is, right? It's not automatic enough, right?
Yeah, and
so we're making it somewhat easy, pretty easy for people to go to zero and then go into negative amortization. So forbearance is nice, but then it's all building, and you come back off of forbearance with a much larger debt. So it's, we're letting people easily do something that is potentially quite bad for them, when some additional complexity, potentially, would let them be, complexity on our side, not on their side, would let them be in a system that insures them better.
Yeah, and the forbearance is still, again, with our system, right, it's still opt-in. Like, as easy as it is to opt in, it's still opt-in. And I think my sense is the reason why you see people default even when they have not used their forbearances is they never talk to their servicer. Right? I mean, it's like, to my sense, it's probably the only reason why that could possibly happen. Here, I'm offering you a free benefit to set your payment to zero. You have to do nothing except say on the phone, yes, I'd like that.
Imagine if we lost our, you lose your job and you still kept getting bills from the Social Security Administration to pay for your Medicaid, your Medicare, and your Social Security, and for your taxes. Oh, you owed $1,000 in taxes this month. Send it in, right? That is not how we set it up. It's like when our incomes change, we pay fewer taxes, and it's automatic. But with the student loans, the bills keep coming.
It might be worth to sort of mentioning, though, that in the current system that we have now, I think there was a comment about how it's not based on current income. Well, what is it based on? And this is actually where our system is really sort of sloppy and messed up, which is it's your most recently filed 1040, right, your income tax return. So just bear with me as I walk through this, show you how sort of screwed up this is, right? So if you were, say, for example, in graduate school over the past year, And maybe over the course of the year, you earned $20,000 a year while you were in graduate school, right? And you just graduated, and now this coming winter, November or so, your student loans will come due. Your grace period will end. Okay? So you're going to use income-based repayment. And you're going to go and file, and it's going to ask you, and meanwhile, you've gotten a job, by the way, earning $60,000 a year, right, at this point. So the form is going to ask you when you fill out income-based repayment, say, oh, well, throw in your most recently filed 1040. Well, that most recently filed 1040 says you were making $20,000 a year. And it's going to base your payment off $20,000 a year, but you're earning, what did I say, $60,000? So this is the best part. Here's what our system does. Here's how we correct for this. We ask the borrower, is your current income substantially different than the income on your most recently filed 1040? Yes or no? He's just sort of like, what's substantially different? I don't know. If I answer yes, I have a higher payment. Gee, I don't know, maybe no. Is anybody checking this thing? And so I check, I check no, right? And then the next year rolls around, which, by the way, your enrollment and re-up in income-based payment is an arbitrary date, right? It's not like April 15th every year, like we all know for income tax. It's whenever you last enrolled in it, right? And so
Or had your application approved.
whenever your application was approved, right? So that's when you have to re-up each time, which is another mess. But anyway, when you go to re-up the next year, right? So you started making a $60,000 salary in August, right? And so when you go to re-up next year, it's going to ask you for your most recently filed 1040, which is going to show you earned an income of about $25,000, even though your annual salary was 60, and that's what you're making. That's what it shows on your tax return, because that's all you made for that portion of your year. So now you've gone 2 years in payment, in income-based repayment, on a $20,000 income, which that's not really what you were making. I mean, it's sort of, and so it goes the other way too, right? We all talked about these scenarios where you lose your job and your payment should be lower than what it really is, but there's a whole bunch of payments that should be a lot higher than what they are in the current system.
And the interest is accruing.
And the interest
So you
is
are
accruing.
ending, while you're in the interest is still accruing, right? And so you're ending up probably in negative amortization again. So
But
even
you're,
people,
but you're 2 years closer to your loan forgiveness.
well, yes,
Yeah, if you get it.
yeah.
Right, if you get you, right. So really, under this scenario, right, public service loan forgiveness is really 8 years of payments based on your current income, not really 10.
Rohit, one of the things that comes up in the context of this whole back and forth over employer withholding is sort of how people prioritize student loan payments relative to other things in their life. So what's your thoughts on how this would impact that, and is it positive or negative?
That's right. Yeah, in consumer financial services, this is the concept of payment hierarchy. And if we look at the data from consumer credit reports, we know this is true of essentially the working population as well as young people, that essentially people are paying their auto loan first, then they're paying their mortgage or rent, then they're paying their credit card, and then they're paying their student loan. And I would just try and actually have people really think about the people who experience shocks. And I think the shocks not only are job loss, but divorce or medical ruin. When those types of events are happening in your life, your financial life is in a tailspin. And being able to keep your car to get to work, or to have a roof over your head, or to actually stay liquid with a credit card is for many people going to be much more materially important to get by day to day. So the extent to which we make the system simpler, that it automatically corrects for that, that could be a benefit. However, one might also say that if your student loan payment rises in payment hierarchy, that might actually increase the level of distress or the likelihood of distress on some of these other consumer credit products. So, and I have to tell you, a few years ago, someone who works in the credit card and auto industry said that if we had such a payroll deduction system for student loans, that would be a real problem for credit card issuance and auto loan issuance for that group of people, because that could materially lower some of their perceived recoveries on collections. Now, I don't know what data that is based on, but it illustrates that there is actually an issue of where someone is putting a very finite amount of dollars with the obligations they have. And the design choice in some ways cuts both ways. And I think one of the things that is important that we didn't really surface is what is the, I don't know the best way to talk about this, but the protected income. So
The threshold,
the
payment
threshold.
threshold is
So
what it's called.
currently, in the U.S. system, we have it essentially as a proxy, an amount above the poverty threshold. That it's not a huge amount, but if one were to, that is an important dial as one makes a design about how that might impact also the ability for an individual family to meet their other obligations in addition to their student loan.
Because that's the threshold below which we are saying the student loans have a lower hierarchy, or below in the hierarchy, your
Correct.
other needs. So below that threshold, we are automatically saying, without you having to make any decision, that your rent and your car, anything else you need to spend your money on, is more important than the student loan, essentially, right? Because we're saying below, so in Australia, below 45,000 US, spend your money on everything else but student loans. Above that, you start contributing. So, it's actually, we by setting the threshold properly, you are actually making it easier for people to put primacy on those things that are critical.
So when we brought together a group of people who, advocates, policy experts, and to talk about some of the implementation challenges around what we call automatic income-based repayment and payroll withholding, right? So the two go together. And I was a little bit surprised that some people raised this issue. Rohit was there. Some of these people raised this issue around they didn't like this idea because they thought it removed sort of discretion for the borrower, right? So that if this money is withheld from my paycheck before I can get at it, then now I have less freedom. And so they were opposed to this, which I thought was sort of fascinating because basically like it's really important that people can go delinquent if they see it important to themselves, which was sort of strange, right? Like they should be able to default or be delinquent if they want to. They don't want this to be automatic.
I'd say the trade-off is between insurance and automaticity. Right? I pronounced that correctly. So like Social Security, we automatically have to pay our Social Security, but that is insuring us against being poor when we're old, right? So, you're trading off two things. I am going to be insured against, the depths of poverty when I'm old, but I am having to pay some payments to Social Security. And similarly, it would be, again, a dial is a good way to put it. We're going to pick, okay, advocates, below what threshold do you think people should be paying nothing? Help me and work with me on picking a threshold. And infinity is not acceptable. Okay, we actually have to pick some sort of threshold.
Okay,
and
if it's
above
not
that
infinity,
level,
then, well, it's different for everybody.
oh, come on.
Well, I guess, Jason,
That's their version of infinity.
Well, that's,
there is a legitimate design question there of when there is a threshold and it is through a employer payroll deduction system, do the deductions start after you hit that threshold? I mean, I'm not saying what is the answer, but these details, I think, are the dials that we have to adapt if we were to do something like this to our own labor market and culture that,
good Lord.
Sorry.
I guess I said something bad. But I think and I think it's important as we synthesize what they talked about of what those levers are and how would we adapt them.
And it's even more beyond the threshold. You pick the threshold, and then once somebody's above it, there are different things you can do. So in Australia, once you get above the threshold, you pay 4%, not just above the threshold, but below it. So they figure you've hit, a certain level of earnings that we think, you need to live on, but now everything gets taxed at 4%. The UK system, my understanding is that there's this threshold, but you only pay above that threshold, right? You don't pay the 9% below that. You earned your £20,000 21,000 pounds, and on the first, it's a marginal tax rate. That first 21,000 pounds, you're paying nothing on it, but then that means you need a higher marginal rate, above that. So two different dials you can turn, essentially, with the understanding that, if you're not paying anything below that threshold, you mechanically are going to need higher rates above it if the system is going to pay.
If we were to move towards a universal, automatic, income-based system in this country, I wonder whether it'd be better or worse, I'm not sure which, I'm just kind of throwing the idea out there, to stop calling these things loans and instead of thinking them as something, maybe it's more really akin to a tax. And people don't like loans, they don't like taxes, so I'm not sure politically which one people
They call it a
hate more.
contribution scheme in Australia, and the framing is that college is free, but if you make out well, if your life turns out well and you're paid well, then you're contributing to the next generation.
Right. So maybe we
Right.
need
So the behavioral framing of this it matters.
So maybe we need a nice name like Social Security, right?
Right.
Where it's
Yep.
not a tax, it's not a loan. And I think part of the problem with the loan terminology is people lump it together with all of these other things that we call loans, like mortgages and car loans and whatnot. Whereas at least the government version of this we're thinking of in a very different way. It's that I think as our speakers talked about, you're accessing your future earnings and the government is enabling you to make that transaction. And so if we're telling this to kids, but we're framing it as a loan, and they know loans as, auto loans where their parents didn't make the payments and the repo man came and took the car away, that's very different. And then if we are really going to think of it as a tax, well, then maybe it's not so problematic to put it top in the hierarchy with your payroll taxes, as long as you have some kind of reasonable offset, as we talked about.
And I think there's a behavioral element of whether someone has the option to pay off the loan, and whether there's
You do your taxes. Oh, wait, no, never mind.
That's what I'm saying. This is a key difference, is that you can't prepay, with certainty your future taxes. And the issue with loans is, of course, people are wanting to know what their payoff amount is if they succeed more than maybe expected. And that's a huge part of knowing, and we've gone through a lot in this country about prepayment penalties, and we banned them on all sorts of student loans. And I think if someone doesn't believe that they can pay off their loan, that will be a material behavioral
Let's flag
impact.
that as a question to ask of the international panel when they come up to tell us if there are prepayment penalties in their systems.
I think one way to make it not a loan anymore would be to get rid of the balance, right? If we move towards an income contingent system where you're paying a certain percentage for a certain period of time, maybe with some kind of cap where you can't pay more than twice the original amount you borrowed, something like that. Well, now it's not a loan. We're not calling it a loan. You can't prepay it because just like your taxes, you can't prepay something that's not a loan that's really a percentage of your income. And I think that would also have the advantage of, in the current system and in a lot of these income contingent systems, the taxpayers accept all the downside risk of people who aren't able to repay their loans, don't make enough to make up for the money that was lent to them. And the borrowers get all the upside risk, that when they're hugely successful, they only pay up to what they borrowed plus interest. So to me, it's not crazy to move to a world where the government get a taste on both ends.
But just when we say prepayment of our mortgages, and I think of our student loans, we're thinking that the term is 30 years for our mortgages, 10 years for our loans. Are we paying it off faster than that? And we heard from, Bruce, for example, that, the payment term is basically forever, but people who do well might be automatically, without
Correct.
doing anything, paying it off in 4 or 5 years. So their earnings are high, and automatically they are prepaying their loans without having to do anything affirmative.
And there is a noted balance, though. That's, I think, the critical design
And that's
piece
doable.
there.
I mean,
Yep.
that's doable
Yep.
as well. I think this is, the nerds are up to this.
So to your point, though, about the sort of, behavioral reframing that has to happen in order to do a system like this. I was sort of struck by the last example of the UK loan that is essentially actuarially or net present value equivalent to a US loan. The US loan is paid off in 10 years, and the UK loan is paid off in, I think, 25 years? 25 years, right? So it's a lower amount with a longer term. But my sense is that Americans would be like, well, wait a minute, I don't want to pay for 25 years. That's terrible. I'd want to be done in 5. Right, so we have this this is a big hurdle to get over to say if you want to have a lower threshold or a bigger exemption and all these things, the term has to be longer. We did some focus groups around income-based repayment, and when we tell people, well, you can get loan forgiveness after 20 years. By the way, the U.S. has an earlier loan forgiveness than all the countries you heard from here today. More generous loan forgiveness term. 20 years sounded awful to them. They were like, that's terrible. How does that even help me? And so, so this is something that we sort of have to work on and get over that for whatever reason people think that these terms are really, really bad.
Well, I think everybody would like to pay nothing forever or very little for a short period of time, right? So it tends to be that surveys of people, when you talk about what they're willing to pay for and what they want lots of government services and very low taxes. And somehow we have to work with that, right? So similarly, they would like high loans with low repayments and early forgiveness. So I don't know whether we tend to yield good information from or actionable information
Sure.
from these.
But the historical context is important here, though, which is that we do have people who are, of a certain generation that they paid their tuition by waiting tables in the summer. I mean, this is just a fundamentally different frame of mind that when you go into the working world, that you're done this obligation. It moved to paying a small amount over 10 years and it being pretty reasonable. But for certain people, we actually have millions of people in extended repayment plans now that are not income driven. And I think the challenge is what Jason is saying is legitimate, that the idea of paying for 20 to 30 years, even though it might be a great way to avoid default, is not what they feel like, frankly, their parents and their grandparents and their country promised them, that they would have this chance and be done. And I think that is a psychological challenge and barrier for many people.
I think that people are graduating from school and they're looking at, and I don't know if there have been, I think Leslie Turner may be working on some experiments along these lines. And we'll make sure you ask a question in the form of a statement or vice versa. Nobody else can do that though. When you're coming out and you're faced with the options, you got to pay off this debt and you can do it as X over 10 years or Y over 20 years, that makes it a bit more concrete. I mean, my personal story is I'm still paying off my 20-year student loan at 8%. Right? This is completely irrational. I should have paid this off a long time ago, but Navient is still getting my monthly payment, a couple of more years. And for me, it was because when I was coming out of graduate school, I was terrified that I wouldn't be able to afford payments on the 10-year plan. So I opted for the extended 20-year payment plan. It came out in '99, and I've got some loans from when I was in undergrad, so I got some 8% loans. But for me, for some people at least, seeing a smaller payment over a greater horizon is going to be, so this is the Swedish system. You take even a loan that's like $20,000 and you spread over 25 years, you're looking at payments of $70 a month. I think that's not workable, except for most people, except with a pretty low interest rate, right? Because otherwise, you end up paying out an enormous amount, like me. Yeah. And I'm the best investment I ever made. Thank you, U.S. government.
That's right. In the Swedish system, that calculation you just cited, if they were to use our Stafford loan interest rate or our unsubsidized loan interest rate, the payment would go up 50%.
So it'd be $100 instead of 70. Yeah.
I think we're running out of time, but so I wanted to ask you, now that you brought up the Swedish system, clearly of the countries we heard from, they were one that went from income contingent to a modified mortgage loan. Do you have thoughts on what were your takeaways from that part of the presentation?
I think there are a lot of systems that can work well, and there are a lot of systems that can work terribly. And in the US, we've landed on one of the many systems that can work terribly. So I think it is possible for us to modify our mortgage-based system in a way that works, right? And basically the modifications you would make would be the ones that would make it look more and more like an income-based program, right? So longer repayment period, easy applications if you are in some sort of financial distress that are automatic and change, so if you're going to have a longer repayment period, probably a lower interest rate. So basically, you can, if we like politically the idea of a mortgage-based system, but you build into it a lot of protections for low-income folks, you're getting kind of close to an income-based system. The downside that you don't get, however, is people being able to pay off automatically quickly, right? So an advantage, I would say, of an income-based system over a mortgage-based system is that people who are earning a lot can pay off very fast automatically, and that's not baked into a mortgage-style system.
Great. Well, we're out of time. I left
Okay.
you with 30 seconds to spare.
All right.